Good afternoon, ladies and
Hello, Mike.
gentlemen. It's Jesse Colombo, Cyber Trading University's Forex and Futures instructor, and I'm excited to have Larry Gaines from Power Cycle Trading on our closing bell today. His topic is called How to Profit from Earnings Season Right Now, a Trader's Game Plan. So, Larry's going to be showing us his favorite earnings season non directional weekly option strategy today. He'll also be showing us how to find volatility in the financial markets and how to use it to your advantage with these weekly options. He'll also be discussing how to find the best stocks for an earnings trade, a screening process to find the most probable winners, and the best trading tool for earnings trade, and much more. So thank you so much, Larry, for coming on. I'm looking forward to it. You can share your screen when you're ready.
Okay, well, thank you very much for having me here today, Jesse. Let me
My pleasure.
get this thing started.
You can just go on to desktop sharing.
Oh, okay. Oh, okay, got it. Yeah.
hmm If you can just have it in a separate window. If you
Should
have,
I upload? I guess add.
are you
No, oh,
using
sorry. Hold on.
multiple monitors
I was
or
just gonna no, I was just gonna do that capture thing, but okay.
do you have multiple monitors at all, or is
Yeah,
it?
I do. Yeah,
Okay,
can you
so
hear me? Okay.
yes, I can. So if you can just
Okay.
have
Oh, now I got it.
if you can
Yeah, I
just
got
have
it
the
now. Okay.
PowerPoint on a
Sorry.
separate window, that'll prevent this type of it'll prevent
Okay.
this mirroring effect.
Yeah. Let me get.
I just stopped it. You can just show it if you can just show it on a different monitor, it'll prevent that.
Okay. Oops. Sorry. Hold on.
It's okay. I see it now.
Let's see. Do you see my whole PowerPoint or what are you seeing? Just the monitor?
I see parts of it. Let me see.
Oh, okay. I gotta resize then, I guess.
Yeah.
Okay. Oh, I got it now. Okay. Just doing that. All right. Okay. How does that look?
There we go. Excellent.
All right. All right. Let me just, okay. Okay, great. Sorry about that, guys. I usually use, well, I do use GoToWebinar, so it's a little bit different. All right. So, well, thank you very much for having me here today. And we officially get started tomorrow on earnings, so this will be a great subject to be talking about today with everybody here. So I'm going to go through, how to find volatility. Jesse kind of went over this before, but a screening process that I use to find the kind of high probability winning type trades that I'm looking for, a checklist that I go through to kind of help systematize everything, my favorite trading tool that I like to use, and then uh, kind of my favorite non-directional earning strategy. So a lot to cover here, so let's get going. The following webinar is purely for educational purposes. Any stocks, options, futures mentioned does not constitute advice and should not be construed as a recommendation. I've been actively trading for over 30 years, and I was previously executive vice president for one of the largest oil trading companies in the world, Trans World Oil, and ran their international trading desk for over 10 years out of Bermuda. So a lot of experience in the trading side of things. And as everybody here hopefully knows, it's a total journey of learning, so you never stop. And it was a great learning experience for me, and I'm still on that journey. Uh, we were also one of the first groups to start trading over-the-counter options on crude oil, and I started doing that back in the mid 80s, and then went on to launch the over-the-counter crude oil option brokerage desk for PVM London, which is the largest privately owned oil brokerage company in the world. So another really great learning experience for me there as well, learning a lot more about the various option structures and getting to work with some of the big, large institutions and hedge funds. So, a real eye opener, just a different experience altogether from being at that end of the trading. So, a constant journey again. So here's circa 88, me in Bermuda, and my first option trade was 1987, the year before we started trading options on cargoes of crude oil. And so that's where I first got my taste and just kind of been in love with options, all the various options that you get from using the various option strategies. And today what I wanted to talk to you all about is, how this can really help your trading to kind of get you into trading during this period of high volatility. And it's another way for you to add additional income stream to you if you're not quite ready to, jump into, a lot of the other type of markets. This can add some additional P&L to your profit statement, and you can participate rather than sitting on the sidelines. So, trading for yourself is super rewarding, but you do have to stay educated about what you're trading and stay really focused on managing your trading risks. And, it's also can be a very painful profession, as probably everybody here can attest to. So when I went out on my own and started trading my own account, the whole game really changed for me because the style of trading became so much different. So I had to really kind of revamp what I was currently, what I'd been doing as far as managing, a large amount of other people's money. And in my opinion, the most important trading lesson is that you should not just be focused on making money, but you should really be focused on managing your trading risk, and then the profits will come. So, today I want to get everybody started and kind of ready for an earnings season that really kicks off tomorrow with the Alcoa. And thing about earnings season, I think it'll probably be even more volatile this go around, but volatility is something that as an option trader you kind of embrace and look forward to. So it's coming 4 times a year, and so why not try to take advantage of it? So that's what we'll talk about here today. So ask yourself this. Now, what if you could add a new stream of income now? Would it change your life? And if the answer is yes, then do you have a plan to achieve that goal? Now, developing a new income stream can take years to achieve, considering the amount of education and work that's usually required. But what if you could learn in only a few hours how to add a new stream of income by creating option spreads to capitalize on stocks reporting their earnings? So that's what we're going to kind of get into here today. So have you ever been confused by the weird movement in a stock price during its earnings announcement? Have you noticed how earnings can be just horrendous and the stock can go straight up, or earnings can be off the chart fantastic and they go straight down? This is what I call the earnings confusion. So, what's up with all this? Now, when a company has an earnings conference scheduled, many times there is going to be speculation not only into the accuracy of the projected earnings that they're going to be talking about at their conference call, but also other factors can come up as well. And one of the great examples to put forward was that one when Apple, announced that they were doing that 7-for-1 split, and that was at an earnings announcement. So you can have all kinds of surprises that come out of an earnings call. So that's what makes it very highly volatile and makes it perfect for some of these non-directional type of strategies. So it's the uncertainty of all this that typically causes volatility in the shares themselves. And the diamond in the rough is actually the temporary parabolic increases in the exchange listed options on the underlying shares. Now, here's what happens. Traders will tend to stay on the sidelines going into the days that lead up to an earnings conference call or the release of their earnings. And you'll then all of a sudden have call buyers start to swap out shares of stock for long call options so they can participate in a rise should shares move higher, but they also are looking to limit potential losses should those shares move lower. So, they're replacing stock replacement type strategies. So all of a sudden you have all this demand for that call buying coming in at this one tiny, kind of window, and that is some of the kind of demand that will push up implied volatility. Now, this, causes those call options to trade in many cases at drastically expanded volatility levels. Then also you add to that the put buyers that come in and they force up the option prices higher as well because they're trying to protect their positions from any major downside move. So you have all this demand of put buying, call buying coming in at one kind of short time frame, and that really presses implied volatility higher. So as the individual trader, you can take advantage of this uncertainty and volatility in order to capture profits, no matter what the crazy earnings reactions are, if you just use the right type setups. So step one is then, how do you identify and qualify a particular stock by looking at its, past performance heading into earnings. To find those stocks that have their earnings release closest to a weekly option expiration is the first thing I want to do. I want to have a kind of a short duration trades because what I've found from trading earnings is that if you get into a trade and say you did a monthly option or something where it has maybe 2 weeks till expiration or something, then the stock has a lot of time to correct and go, do different things. But if you have a short type duration option on, which is a weekly, you get that earnings announcement, it comes out, you get a nice spike perhaps to the upside or downside, and if there's not enough time for it to, recorrect or correct itself. So a lot of times if you have a short duration with 2 to 3 days to expiration, you can get these big moves and they'll just kind of stay up there or stay down, so you can capture that whole move without having it swing back against you. So that's one of the prime reasons that I started looking at just using weekly options or an option expiration, that's an earnings in the monthly option expiration time frame. So step two is then I look at past performance to see what volatility has done previously to a stock as it moves closer to its earnings release, and then also after. So what I found is you'll see a lot of times 3 different type of earnings cycle trades. You'll see the trade one is a trend trade into the earnings release where it's trending up until the day of release. And then trade two is the actual earnings release type trade, which is a non-directional trade. And then 3, a lot of times, a lot of these stocks will have a post-earnings type of trend after. So there are 3 possible opportunities there for some nice trades. Now, a smart trader is going to look for the dramatic increase in the front month volatility, as a stock approaches its earnings release. And a stock's front month volatility may normally be around 25-30%, but when the earnings are just a couple of days before option expiration, you can see that volatility easily move to really high extremes. So here's an example of SanDisk back on July 16th, 2014. You can see here the normal earnings were, implied volatility is about 35% or thereabout for SanDisk, but as you get into that expiration, 3 days to expiration, the week of its earnings announcement, it pops up to over 72%. So huge increase in the implied volatility there. So that's what you're looking for to take advantage of. Now here's, that first type of trending trade that a lot of times you can capture. And this again is on that SanDisk particular trade during that July 16th cycle. So you can see here SanDisk, just a nice, trend to the upside here. And what you're going to capture is also the trend to the upside on the implied volatility down here at the bottom part. You can see that implied volatility just increasing as you get to this date of expiration right here. Now, so this is kind of a twofold type of move. You've got one, price moving up, but then as the implied volatility moves up, that increases also has an increased impact on the premiums of the options. So you get the delta effect of pushing option prices higher and the implied volatility pushing it higher. So it's always a good idea if you're looking at a trade going into an earnings announcement to buy options. Don't be selling into the option announcement. So one rule right there. Now, the other rule that I always maintain is that when you get to the date of earnings announcement, so in this situation on the 16th, if you were in this trade long, you want to be out the day of that earnings announcement because you don't know what's going to happen, after they announce the earnings. And in this case, you can see price collapsed. So you want to have this trade set up, be out, put on a non-directional trade there, take advantage of the collapse, and also you could take advantage of this collapse and implied volatility with the right non-directional strategy. So here are a couple other examples of these type of trade setups. Here's that trade one. This is on Amazon. You can see it's just trending nicely to the downside here in this channel, all the way down to the day of its earnings announcement right here. And so you want to, here you could have bought puts, and then the implied volatility moving up is going to increase those price of those puts plus the price direction going down. So you have that two compounded effect there. And then you want to be out of that trade though and looking for your next trade if you want, which is the non-directional trade here, to take advantage of either an explosive price move up or the impact of volatility collapse. So that's that trade one, and that's trade two. Now trade two is here where you have the earnings release. So here is release right here. So you'd put on a non-directional here. In this situation, I'll show you later this particular trade setup, but you're looking for either explosive move to the upside or downside. And in this particular case on Amazon, it got that explosive move to the upside. So a really great way to capture profit from that. And then trade three is to look for those trades or those particular stocks that tend to have a post-earnings trend, which Amazon does. So here you have a nice trend to the upside. So three different ways that you could trade Amazon or any of these stocks as you're approaching or into an earnings season. Now this is really what makes a stock potentially a great trading candidate, is its past performance and the increase in its implied volatility. So implied volatility, will normally double, and in some cases it can be even more extreme than that. And this is what you want to look for. That's the opportunity in a lot of these trades. And it's for this reason it's essential to have a watch list of stocks that you can monitor closely, due to the fact that they may not all represent an equal opportunity for an earnings trade. And remember, the goal is to take advantage of that temporary rise in the implied volatility. That's the opportunity that you're looking to take advantage of. Now, a stock option needs volatility, and without volatility, you have no price movement, and without that price movement, you pretty much have no chance to turn a profitable trade. So then how do you find that volatility and turn it to your advantage? Well, it's for this reason, volatility. I put together a process that I use for building my trading list of stocks to look at into their earnings release. And I'm looking exclusively for high volatility stocks that have those weekly options, those short duration type options to take advantage of. Now the screen that I put together, it tracks the following kind of data. So first off, I track that stock, whatever stock I'm looking at for an earnings trade, I track its volatility. I look at its liquidity. I want that particular stock to trade over 1 million shares per day, so it has liquidity. And I'm constantly tracking that straddle cost, which tells me what the volatility is as it's going into its earnings announcement. And then 4, I use the pre-earnings implied volatility, that particular implied volatility, to help to forecast what the expected implied move of the stock will be after its earnings announcement. And then 5, I look at past earnings moves from 1 day all the way to 21 days after an earnings release, to see if that particular stock might have that tendency to trend after an earnings release. And there are a lot of them that will have these kind of tendencies to either trend into earnings or after release, or sometimes both. So one major element to trading earnings release successfully is knowing what the stock's implied volatility or its expected implied move is, and then knowing how to use this information, for the trade setup. And this number, it's expressed as a percentage of the stock price, indicating what we call a theoretical 1 standard deviation move over the course of the stock's option cycle. So it's this statistical forecast of probability that is the foundation for an earnings trade, and it's a foundation for most option trades in general. So here's what it looks like. Now let me see if I can get this pencil to work. Okay, so the implied move is theoretically what the marketplace theoretically expects the price of the stock to do based on that stock's at the money option price. In this example is Google. So this is a normal distribution curve. It's that bell-shaped curve for distribution of data. And so if you look at this, the inputs will be here. It's 3 days to expiration. So that's an input into the option model. And then the expected implied move, this is your implied volatility. Expected move is plus or minus 4% in this example. And then you're starting out here at the money. That's where all option pricing starts. It's at the money. That's where all the demand is, and the supply demand starts at the money. So once this particular option price is set, then you can set the outer prices, the outer strikes on the calls or those outer strikes on the puts, and that's called your option skew. So in this particular example, 3 days expiration, implied move of 4%. So that says that the implied move is down to $480 and up to $520 in 3 days. So it's this price move between those two numbers. That's the expected move. And it's that expected move, which is a theoretical one standard deviation, which is 68.2% probability. So what the market makers are saying is they're giving this stock a 68.2 probability that it will trade between 480, or it'll expire between 480 and 520 in 3 days by option expiration. Now, to go outside of that 520, then you're calling for a bigger, move, and then your probabilities go down, right? Because if you have a 68.2% probability to close inside this, if you go outside, your probabilities of that happening go down and becomes less of a possible outcome. So this is how then you can set up your targets based on those expected move of 520, here, and 480 to the downside. Then you can set your targets and your spreads off of these numbers. So that's how you set up these option trades. Let's see. So it's this implied move is exactly what the marketplace expects the stock to do in theory, and it's the best way to calculate the move. Now, although it's not always 100% accurate, the implied volatility and using the implied move of the stock is super useful, and it's a free tool for forecasting a stock's price movement into its expiration. So even if you don't trade options, you can use this kind of information just to look at the markets that you're trading to see where the expected move of this particular stock or futures should be within a week or 2 weeks or whatever it might be. So you can use this as an additional way to target price movement. Very, very useful. And the option market's so huge that this kind of pricing information can really help you. And again, it's what the marketplace expects the stock to do in theory. So then step 3, I put together a checklist. So, in your trading, it's really good to have everything as systematized as you can for any of your trade setups. And by having systems in place, it helps to kind of take a lot of the emotion out of your trading. You want to be kind of detached as a trader if you can, and just solely kind of mechanical and analytical as much as you can. So it's going to make it easier for you to make decisions. So put together a checklist to kind of help out to do that. And so again, what I'm looking for are those stocks that have to have options and option liquidity. They have to have a good high pre-earnings volatility because I want potentially explosive price movement either up or down. And they must have a stock price move. I also look and scan and screen and filter. I use a certain screen I use, looking for stocks that are have a potential for a greater move up or down of 5% over at least their last 4 cycles. And I also look for prices of over $40. So I don't want to be trading a stock that's $5 or $10 or $20, because the bigger, a 1% move on a $10 stock is not a big profit versus a 1% move, say, on a $50 or $100 stock. So that's what you're looking for, those bigger type of potential profits based on these type of moves. And what I'm looking for is stocks that tend to move more than 5% up or 5% down, and then you can do the math and see that you have some potential for some good profits. Now, the next thing is I look and I calculate that implied stock move on the day of its earnings announcement. That's very key. And using that information, then use that to perform the earnings price target analysis, then to select the appropriate weekly option strategy, entry plan, and then determine the exit plan. So checklist, go through all those each and every time, and helps you to eliminate mistakes and kind of make things very systematic for you. Now here's a kind of a worksheet that I use for every trade that I'm looking to do. And so this is on Netflix. So what I look for here is you'll see this is one of the key things that I like to use is that I'm looking for the implied move the day of its earnings release, and then I want to compare that with what did it actually do at expiration. So in this case, these are weekly options, so it's usually like going to be a third day after. So I have these statistics, and if I look back at Netflix, I can go back here. This is going back 8 earnings seasons or cycles, and you can see that the average implied move, this is the move of where the forecast of Netflix is going to be, X days till expiration. So, back here they were forecasting a plus or minus over 11% move, 6.51, 8.05. So look at all these. These are pretty big moves. And then I look at the average. So on average, Netflix, the expected move on a Netflix earnings release day is a little over 11% up or down. That's what they're saying they're forecasting Netflix to do. So, if the price here on that day closed at 475, right here, the market makers are saying they're expecting Netflix to be up 9% or down 9% by expiration in 3 days. And you can see that they being the option makers, have been giving big expected moves on Netflix for all these earnings cycles. Then the key next step is, okay, well then what did it actually do at expiration? Did it exceed this move, or did it fall under this move? And then you can determine what kind of strategy to do. So if you look at what it actually did, here it was up 25%. The last earnings cycle is up 20%, down 25. So if you look at that, you can see that the expected actual move at expiration was actually bigger than what they were expecting. So on average, it's almost 13% up or down. So it's a huge mover. So it's this information here that tells me what kind of option non-directional strategy to do for Netflix. So that's the thing that I want to study that. Now here's another example. This is Amazon, same type of workup. And here's Amazon over 5 cycles. And it tends to move the implied move based on the day of earnings release, tends to be, almost 8% up or down. Now, what does it do at expiration? So I come over here and I tally these statistics that I keep. And it also tends to exceed the expected implied move of almost 11% up or down. So this type of information tells me what kind of option strategy non-directional to do for Amazon. So that's the thing that I do for each stock that I'm looking at. And then step 4 is the power of the weekly options. So, again, weeklies are one of the most lucrative trading opportunities that still exist out there because they have defined risk, because the accelerated time decay, they can have very low cost, and they offer some high levered returns and in a short period of time. So the mechanics behind this is that the two main advantages are that you've got that time value, which is accelerated, and then you want to take advantage of the implied volatility. So by combining these two elements together, when used correctly, this can really create a great winning, low cost, defined risk type trading formula that can really generate unmatched type of returns on your trading capital in a very short period of time. So the key, though, is that time decay. So you can see how accelerated this is. Each series, you come out with a new series on Thursday, and then you've got, I call it time decay on steroids. You can see that it's just decaying about 12% a day, and all of a sudden you're at zero. So what this can offer is, as a option trader, when you're trading these type of earnings type trades, you can offer you the volatility and time decay collapse, or it can offer you really cheap options to take advantage of that explosive move either up or down on buying some of these option spreads. So if you know which weekly option strategy to use for an earnings trade, how to construct the trade, and when to execute it, then the weeklies produce some exceptional fast profits due to that incredible leverage they offer, and also they are perfect for trading vehicle for earnings because that short duration that they offer you. Now, the next thing is then how's this done? What strategies do you use? Well, there are a number of different ones that I'll use, and then what I'll do is I'll do a comparative option strategy analysis. And when constructing an earnings option strategy, I'll compare the risk to reward or your return on your capital at risk between the various strategies that you're looking at using and compare those, and then I will, select the best risk reward for my trading type goals. So everybody here, you'll have different goals, different capital accounts, different risk profile that you're willing to take, things like that. So you have to take that into consideration as to the type of strategy you want to use based on its risk to reward. And at times there are going to be more than one strategy that you could also employ on this type of trading. So these are some kind of past trade examples to illustrate this one particular strategy I'll show you next. But you can see just from this table, these are short duration, 1 day, 2, 3 days, and the return on capital is around 25–30%. But the key to this is selecting the right stocks and the right strategy. So here's this was back last year, the July-August series. You can see the consistencies, short duration trades, 30, 13, 40%. Those are kind of the usual trade setups, and profit return on capital you'll look at. Same 2, 3 days, 1 day. This was back October last year, fourth quarter, and then first quarter of 2015, kind of the same, very short duration. Now, I won't do these trades unless, probably the most would be a 3-day expiration. And here we are for the last series in April, May. So what is the strategy and how does it work? Well, again, there are several methods that you can use to capture profits from the extreme price volatility that surrounds every earnings season. And each method works best based on certain circumstances. So I don't like to have to spend a whole lot of time watching trades all day long. So one method I like to use and that I teach most often involves, kind of no work once you have selected the right stock and then once the trade is placed. So basically it's just 4 steps. You buy 2 options and you sell 2 options. So it may sound like a lot of steps, but once you understand the method, the concept, or the trading setup, you just use this same method over each earnings season. So it's pretty simple once you get through it a few times. So here's an example. So this was on Amazon, and Amazon's closing price on day of earnings release was $337.15. So based on approximately, going into this trade around that closing price, it was step 1 was to buy the Amazon 345 calls, sell the 350 call. So if you look at that, that's a call spread, right? Vertical call spread. So that cost you $165 to do that call spread. And step 2 is buying the Amazon 325 put, selling the Amazon 320 put, and that is a put spread, vertical put spread, and that cost $165. So the profit is the difference in the spread width. So 350 minus 345, it's a $500 wide spread, less the cost, your trading capital at risk. It costs you a total of $330 before commission. And then the net would be your profit per contract, which would be $170. Now, the trade made $170 before commission. It was a high probability setup based on the stock selection process. The maximum potential loss, you knew what it was going in, so you knew your max risk of $330 per contract. And this particular trade was you were only in it for 1 day. So if you'd had $1,650 to invest, you could have bought 5 contracts, $170 per contract, that's $850. And that's, based on your capital at risk, that's over 51% return. And that was in 1 day, and it took you about a half an hour to, get into the trade. So bottom line is the strategy, this is the non-directional option strategy, it's the iron condor, and it's ideal for, trading earnings release. So it can be used a couple different ways. It can be used to capture the explosive price movement that exceeds a 1 standard deviation implied move, up or down, or it can be structured to capture the volatility collapse that happens after every earnings release. or you can actually, in some situations, do both. So here's an example, a couple examples. Here was Bed Bath & Beyond last April 2015. And so, just going through the analysis, the implied move on average was 7.7% up or down. So it's potentially a big mover. Then the next thing you want to do, or I want to do, is I want to see, well, what did it actually do? Well, you can see over 5 cycles that it actually exceeded that and was up or down 10.51% when you look at those statistics over past earnings periods. So this is ideal for that explosive price movement type trade where you're looking for it to exceed the expected move. So then the next thing is to set the trade up. So this trade up setup was buying the 79 calls, selling the 81s, 79-81 call spread, then buying the 75.5 puts, selling the 73.5. So there's your put spread. So this total spread cost $1.40 per contract. Your maximum profit potential, it's $2 wide spread. So you've got $2 minus 140, $60 per contract potential profit. So, you do 5 contracts in this situation, that's $300 potential profit. Max loss going into trade, potential 700. And the whole key is to try to trade the setup based on past history to see what's consistent about this particular stock. Now here's the trade setup, what it looks like when you chart it out. You can see here's the call spread right here, long call, short call. Here's the put spread down here, long put, short put. Now what you want is at expiration for it to either be, at or above that short call or at or below the short put, and you make max profit. And at expiration on the 10th, 2 days later, it was right here, right at, it had actually exceeded to the downside, came back up and closed right on that short put right there, which was max profit on this particular trade. So it did make that max 140, which was, $60 profit divided by your at risk of 140. So that's a 43% return on your capital. And here's what it looked like, when you graphed it out on your risk analyzer. So here's the 73.5, 75.5 put spread. Here's the 79.80 call spread. And so as long as it is above that strike or below that strike, it's max profit, and you know what your risk is. And here's another example. This was on Netflix. I showed a little earlier. So the expected move over like 8 cycles is 11%. It actually had exceeds that. So this told me, okay, well then I want to do, a trade setup where I'm looking for that explosive move to be greater than the expected move, either up or down. So here was the trade setup. So it was based on buying the 492.5 calls, selling the 495 call spread. And then the other side of that non-directional part was the 457.5 put, 455 put spread. $2 debit, it's a $2.50 wide spread, so potential $50 per contract. And you have a potential for $250 profit on 5 contracts, max potential loss of 1,000. Now on this particular trade, it blew to the upside. You could have widened that spread out and made a lot more money. So this was a very high probability winning trade. Here's your actual spread right here, the call spread side, put spread side. This is the expected move based on what the market makers gave you, about an 8% expected move right there, the yellow line, but it actually exceeded that and closed up here. So huge move. So this is the kind of volatility that you're looking for that can, provide some fantastic type of movement in 1 or 2 or 3 days on these type of earnings trade setups. So, will every trade be a winning trade? No, it'd be awesome if they could be, but we're never going to get that good. But the thing that you need to do, though, is you need to be able to find the highest probability trade setups, and with a high probability systematic approach where you're finding those kind of higher percentage types of stocks for these particular type of trade setups, it can really offer you some really high winning type trades. So it all comes down to using a very selective and systematic selection process, for the particular stocks that you're looking to trade into an earnings or into an earnings release and then after. So that's the key to these types of trades and setups. Let's see here. So what I wanted just to give you guys a taste of today is just, what to look for, how to, use that volatility and use it to your advantage, the kind of trade setups to look for and what that volatility can offer you. And then a screening process that you can go through to find these type of probable winners, a checklist to go through to make things as systematic as you can. And then the trading tool that I like is, just basically those weekly options and how to use the implied volatility. And then that non-directional earning strategy that I showed you, that's one of my favorites. Now, there are several others that I teach, but that's one that I really like. So, after going through this, what I want to do next, let's see some questions here. And then I want to show you a course that I put together, and then I can get into all your questions. So just take a few minutes, though, before we do anything further and just hear some really nice feedback I got from some of my past clients regarding some of these courses on earnings. Just, you can take a few minutes and be worth your time here. So it's always really gratifying, when you get some nice positive feedback on what you're doing, and it keeps you moving forward to, do it some more. So just wanted to share these uh, little comments and stuff with you guys. So now let's talk about how you can learn, more about these type of option strategies with the weekly options, and some simple things you can start doing now before we really get into the meat and potatoes of the earnings season, which will actually kick off tomorrow with Alcoa. So what I'm going to offer everybody here today is I put together this course. It's the last earnings season I did this course, and it's a 3.5-hour course that was recorded, and it's strictly 100% on these type of option strategies, non-directional basically, for an earnings release. So with this course, you'll get the recording, which is broken down in 30-minute modules, and then you're going to get the training manual, which is the PowerPoint, which is very detailed. My courses are detailed. I'm a visual learner, so I teach the same way with a lot of trading examples. So you're going to get the recorded course, and you're going to get the training manual. Now, for the first 20 that sign up here today, you're also going to get a follow-up as a bonus, a follow-up support Q&A live, which we'll probably do this maybe next Tuesday before everything gets really cranked up. And then you're also going to get my worksheet, not my worksheet, but my watch list of stocks that I like to look at and use going into earnings. So this 5 different worksheets that I've put together for stocks to look at based on certain screens. You're going to get that. And then as an additional bonus, you're also going to get my brand new option butterfly spread course that I just did about 3 weeks ago. So all of this today, if you put in powercycletrading.com/learn, it's $97 for all of this. And if you have a problem with any of it, just send me an email and you get 100% back on your 97 bucks. So it's a total win-win situation. You can dip your toes in, see if this is stuff that you like, and get started, with these type of trade setups. Plus, these are strategies that you can use for a lot of other different types of trading other than just earnings as well. So bonus 1 again for the first 20 here, because I want to keep it small enough groups that I can manage the live Q&A. So you're going to get that earnings course that I just showed you, access to the live follow-up Q&A, and I'll send out a email on that when we're ready to do that. I'll probably do it maybe next Tuesday, just so you can get involved with some of the really good trades that are coming up. And then you're going to get this is a really nice bonus, the stock watch list. So I'm going to save you a lot of time and research, because I put together 5 earnings watch lists of the stocks that I like to look at during an earnings season. So this list is based on 2 types of screens. One is looking for those stocks that have a bigger up or down move of 5% or more, And then I'll do another screen looking for those stocks that don't have a big move. They just tend to collapse and they're 4% or less. So then these are perfectly designed for these different types of strategies to use. So you'll get those 5 different watch lists. And this is kind of what it looks like. This is the current one for this upcoming season. So what I've done here is I'll go through 6 cycles. So I'll go back here and you'll see what the percentage moves were at expiration for the last 6 cycles on all the stocks that I list. So I've done all that work for you. So you can see that these are potentially good ones for a certain type of strategy. And then the next bonus, which is awesome too, this is a great course. If you've never used the butterfly, it's a fantastic course on how to use the butterfly spread, broken wing butterfly, and iron butterfly. So this is a 4-hour course I did just recently, also broken up in 30-minute modules with a 110-page training manual. So it's the amazing option butterfly spread course, and these are fantastic course, for what we call pinning type trade strategies, also to be used with earnings type trade setups as well. Now, in the earnings course, you'll learn my 3 favorite non-directional strategies. They're all really well-defined strategies that go through step by step the strategies, how to set those the various trades up. Each is explained in great detail using actual trading examples. So I'm big on examples of actual trades so you can see and go through the math step by step and kind of dissect it yourself. And then I'll teach you in this course then too, how do you select and construct that perfect or the best non-directional weekly option strategy based on the stock's pre-earnings implied move. So teach you that, how to calculate that implied move, and then using that implied move, how to set up your targets to structure your spread, and then how to trade that implied move. So how and when then to set up all trades, how to manage into option expiration, what to do if it goes wrong, the earnings statistics I use. I'm going to give you the resources that I use for my earnings history and all those stats that I showed you. And then also the big part is how do you use the statistical information to analyze these stocks, these earnings type trades at release and post earnings. So all that's there for you. Plus I give you an earnings trading library of 32 trade examples. This also is in the course. So you can go back and look at all these different trade examples. So it's a library of trades here, and you can go back and look at the setups, all the process that was gone through setting the trade up. So a great way to learn as well. And then the butterfly course, we do a good review of the Greeks, the theta, how that works on butterfly, volatility impact on butterfly, the effects of the time, decay, and volatility. And then, go through the foundation of the butterfly, which is the vertical option spread, teach you the construction and how to use and when to use the butterfly spread. Butterfly spread defense is also a great defense for vertical spreads. That's taught in this course. And then the broken wing butterfly, that very nice trade setup, which can really, put you in trades at a credit or $10 and turn into 190 is, easily situations you can get into. And then the use of the iron butterfly, which is also a great strategy for earnings as well. So a lot of good stuff here. And, again, for the first 20 to keep the group small enough. Now, if I go over a few, it's okay. I just don't want to get, sell 50 and get the room too crowded because I've got some other members coming into this webinar or follow-up Q&A as well. No, this is the only package I have. I don't have any other bonuses to throw in. So you're going to get the Q&A, the follow-up there, and the earnings course. And if you already have the butterfly course, then I guess that's it. I don't have anything else to substitute in there. But thanks for asking. So a lot of good stuff here. Plus, if it doesn't work, email back and refund your money. So this is a way for you to start participating in the markets here for earnings if you'd like, and it's 100% on earnings, and then plus you get that additional butterfly course, which is going to be very useful if you get to it. You can start using the butterfly trades a lot next week for option expiration. So the Q&A, I'm going to probably have it next, probably Tuesday. So give you all this week to go through the course, and then next week is really when some of the really good trades start happening. You'll have Netflix coming out next week on, I believe it's the 15th, and then you'll have a lot of other stuff after that. So really the good earnings trades will all start happening next week and the weeks after that. So let's see what let me scroll back up here. Oh, I just did something wrong here. Oh, I see here. Okay, question, can this be done with credit spreads instead of the debit? Yes, so in the course I teach you, how to take advantage of using the credit spreads for the volatility collapse. That's a big part of these type of strategies to take advantage of that volatility collapse, and then, which you could see from a couple of those slides, how that just totally collapses after expiration. And probably what we'll do too next week, since it's also next week is option expiration, I will definitely plan the Q&A for next Tuesday, because then that gives time to also look at some of the butterfly trades that might be perfect for some pinning trades going into option expiration. In this course, I teach 3 specific strategies. So you'll 2 are just basically based on volatility collapse, and the other is that move for expected, exceeding the kind of expected implied move. Thanks, David. Appreciate that. And even if you don't want to trade earnings, the course is designed so you're going to learn how to use these particular spreads, which are, credit spreads, and some iron butterflies, which are, the kind of credit spreads. So a lot of, great way for you to get involved in options for a very, very low price with two courses for the price of one rather than one. So, plus you get a money back guarantee. So it doesn't get too much better than that, I don't think. Any other specific questions? Oh, okay, the Q&A. I'll probably have the Q&A probably around 11:30 Eastern time, around lunchtime. So that'll give people the opportunity to be in during the day at lunch or something. And they're also recorded, so if you can't make it, then it's going to be recorded, and then you catch the recording later that day. Yeah, so the link, yeah, it's powercycletrading.com/learn, LEARN. Yeah, so if it feels over your head, this is actually a great way to get started. So it's a very easy way to get started into options at a very, very, very small cost. With capital, you can kind of get an idea here. These trades will cost you, capital at risk anywhere from, $100 to $200, and if some of them, if their credit spreads, will be even sometimes less than that. So that kind of gives you an idea of the cost. Now, if you look at the cost here, though, the butterfly spread, this is what's so amazing about the butterfly spread. Your at-risk cost here on these particular spreads in the right situation are as little as $10, and with the broken wing butterfly, you can put them on as a credit. So at risk per contract, $30, $20, $20, $50, $27, $25, $33, $27. So very little capital at risk, right? These are short-term, fairly short-term trades as well. These particular butterfly. Here's a Batman butterfly. This is a double butterfly. Broken wing butterfly. This is the return on these capitals. So you risk 20 to make 170%, risk 30 to make over 250. So these are really, if you're looking at small capital and secure with low risk, this is one of the best ways to start trading some options, is using this type of strategy. Now, it's not something you can use for every market condition, but that's also taught in the course. So here was a really great iron butterfly trade setup using SPY, the ETF, and at risk 33 bucks and made over 355% return there. So that's the other great thing about this particular course being added. These are very, very cheap types of trades to get into. So you know what's at risk in this type of trade. How many days of the trading year do these conditions? Well, one thing earnings come out that you have 4 earnings seasons, right? So you're going to have a lot of different trade setups for an earnings season. And then the different butterfly trades are good for a lot of different situations that come along. So a lot of trading days per year for all these type of trade setups. So with these particular debit spread types strategy, it's just basically the two spreads put together, the cost of that less the from the width of the actual spread on the spreads that you're using. So if it's a $5 wide spread and the total debits for the two spreads combined were $2, then you have a potential profit of 300. That's just a quick and easy way to look at it. How many at one period of time? Well, I don't really look at how many. I look at more specifically the particular stock itself. So if it's a high probability type stock that's consistently been doing the same thing over and over and over, like, I hate to say it, Amazon has been very consistent for, big move up or down. So I'll always look to do that one, and it could be another one on the same day. And if that has the same tendency, I'll do that as well. So usually, I'll do one, maybe two on the same day. Um, if you get too many more than that, it's kind of hard to follow and manage. Depends on the trader too. If you like a lot of action, maybe no big deal for you to do 4 or 5 of them. But if you like less stress, then you might only want to do one at a time. When I do these spreads, when I put the spread on, I don't ever leg into them because you could really screw up legging into them. Now, getting out is potentially a big part of it. So when you get out of these spreads, in a lot of situations, you're going to maybe leg out of the spread. But when I get into the spread, it's put on as a spread. Getting out can be taken off as, legging. All right, you're welcome. All right, well, if there are any other questions, feel free to throw them out. And, here again, powercycletrading.com/learn. And it's a 2-for-1 Tuesday for everybody here, plus that live follow-up Q&A, plus the list. So the list is updated for this earnings season. So the list will show you the days of uh, uh, earnings release dates. It'll show you all the statistics for the past earnings from, going back 6 cycles. So a lot of good data there for you to use as well. All right, guys. Well, again, thanks very much for sharing some of your time with me today, and good luck out there in the markets, and good luck during the earnings season. So, thanks very much for having me here today. I appreciate it, and hopefully, this is some stuff that you guys can take advantage of. Thanks, Denise.